Welcome to today's Explainer, fellow shareholders. Today, we're going to look at the 2026 US-Iran war a little differently. We're not going to view it as a geopolitical tragedy, but rather as a Q1 corporate earnings report. We're going to put on our investor hats and ask the really hard questions. If this global conflict was just a massive financial investment meant to turn a profit, did it actually pay off? Did we maximize shareholder value? Did we at least get some cheap oil out of the deal? And, if the return on investment turns out to be catastrophically negative, why on earth do we keep making this exact same trade? So here is the agenda for today's earnings review. We'll start with Part 1, the ultimate bad investment. Then Part 2, crunching the war numbers. After that, we'll ask Part 3, did we get free oil? Explore Part 4, the global supply chain meltdown. Figure out Part 5, who actually profited here. And finally deliver Part 6, the final ROI report. We're going to go through the numbers step by step to see if the juice was actually worth the squeeze. All right, Section 1, the ultimate bad investment, initial capital expenditure. To really evaluate our Q1 performance, we first need to look at the massive upfront capital that was deployed to kick off this global economic emergency. It's honestly wild how fast our initial tactical investment escalated into a catastrophic market event. On February 28, 2026, the U.S. and Israel launched joint airstrikes, successfully assassinating Iran's supreme leader. But within weeks, the strategic blowback hit the markets hard. Iran retaliated, and by March, the Strait of Hormuz, which is literally the most critical artery for global energy, was slapped with a giant closed for business sign. According to macroeconomic analysts studying the fallout, the long-term cost of this conflict, what we in the business love to call a negative market externality, is projected to exceed $1 trillion in lost growth, accelerated inflation, and disrupted trade globally over the next decade. That is a staggeringly large bill for the world to foot for a single fiscal quarter. Moving right along to Section 2, crunching the war numbers, operating costs. We really need to talk about the sheer absurd asymmetry of our day-to-day overhead in this conflict, because, as it turns out, keeping the lights on during a war is far from cheap. For the United States alone, the upfront operating cost of the war rapidly blew past $200 billion. That's emergency supplemental funding acting like a giant vacuum cleaner on the national budget. And it arrived right alongside mounting concerns about domestic inflation and stifled economic growth. Meanwhile, over at the Iranian Central Bank, they were dealing with a total financial meltdown of their own. They actually had to print a record-breaking 10 million rial banknote just to keep up with their catastrophic war-induced inflation. Their currency was trading above 1 million rial per US dollar in street markets. I mean, that is just total structural devastation on their end. But look, if you want a perfect picture of a genuinely terrible business model, just consider our defense strategy. Iran's proxies launch explosive drones that cost about $2,000 to cobble together. To stop them, the U.S. military fires Navy SM-3 interceptors that cost anywhere from $9.7 to $27.9 million each. We are literally spending luxury penthouse money to shoot down a flying golf cart. To put this macro overhead into perspective, data from Ginza reveals a completely devastating picture across the board. Iran spent an estimated $2.3 billion on their October missile strike. For a deeply strained economy with a GDP per capita of just $4,500, that amounts to a staggering 51 million% of their per capita GDP. So it's a phenomenally expensive venture for us, sure, but it's pure financial ruin for Tehran. Okay, Section 3. Did we get free oil? Expected dividends. The most crucial question for any shareholder is this. If the United States spent all this capital, did we at least secure a solid dividend for the American public? Did this incredibly aggressive market takeover result in cheap, abundant oil? The short answer is a resounding, market-shattering no. No, we absolutely did not get the oil. Actually, instead of a dividend, we triggered what the International Energy Agency called the largest supply disruption in the history of the global oil market. The Strait of Hormuz completely choked up, oil prices spiked over 30% immediately, war risk insurance added up to $15 per barrel just for the absolute privilege of attempting to sail a ship through the region. So instead of cheap gas, we bought ourselves a surging risk of global stagflation. What a deal, right? And the administration's official guidance on these skyrocketing energy costs to everyday consumers, well, it was surprisingly laid back. When asked about the potential for massive spikes at the pump, President Trump simply stated, if they rise, they rise. Honestly, that's not exactly the reassuring forward guidance investors usually look for during a massive corporate crisis. Which brings us to Section 4, Global Supply Chain Meltdown, Collateral Damage. Let's dig into our macroeconomic metrics and see how this energy shock built into a massive global disaster. Because energy costs stayed elevated, inflation fears mounted incredibly fast. This pushed U.S. 10-year Treasury yields back above 4%. And for the average person, this means your borrowing costs, things like your mortgages, your auto loans, business loans, went heavily up, right when the everyday economy desperately needed some relief. And absolutely no region was spared the financial pain. Asian equity markets faced major sell-offs. The EU, which was still bruised from previous energy crises, faced a renewed threat of fuel shortages. The UN even projected that Arab nations could lose up to $200 billion from the fallout alone. Ultimately, this war acted as a massive, completely unavoidable tax on every single fuel-importing economy on Earth. So, Section 5. Who actually profited here? The real winners. If everyone's balance sheet is bleeding red, you really have to ask, who actually made money on Operation Epic Fury? Because in every volatile market, there is always someone taking home a profit. Well, it certainly wasn't a total tactical victory for the military brass. Despite targeting Iran's entire military-industrial base with literally millions of dollars in precision-guided munitions, intelligence sources confirmed that only about 1/3 of Iran's missile arsenal was actually wiped out, meaning the underlying threat and the continuous need for incredibly expensive defense systems to counter it remains completely intact. So the undisputed, absolute victors of this financial bloodbath? The defense contractors. The U.S. administration officially declared that arms production must be quadrupled to replace the rapidly exhausted supplies of interceptors. When the government is forced to fire $27 million missiles every single day, the folks manufacturing those missiles are seeing an unbelievable, unparalleled return on investment. Finally, Section 6, the final ROI report. Was the juice worth the squeeze? Let's finalize our corporate earnings analysis and look at the ultimate bottom line of this geopolitical venture. Iran sustained an estimated $270 billion in economic damage. That is roughly 57% of their GDP, setting their economy back years. But here is the major catch. It failed to completely break their structural resolve. Decades of heavy sanctions mean Iran's system has already learned to function under constraint, using informal trade networks and opaque shipping. We severely damaged their headquarters, sure, but we didn't actually put them out of business. So, as we close the books on this explainer, we really have to wonder about the logic of this entire portfolio. If the ultimate return on investment is a devastated global economy, rampant inflation, completely disrupted supply chains, and firing multi-million-dollar interceptors at incredibly cheap drones, all while the target adversary survives to fight another day, is it time we declare bankruptcy on this strategy? Thank you so much for joining me on this earnings review. Let me know if you'd buy the stock, and always keep asking the hard questions about where our global capital is really going.